Tuesday afternoon market recap. You are here with James. First of all, I just wanted to say, please take care of yourself, take care of your loved ones. Right, I hope that you are all doing okay, no matter where you are located around the world. Obviously, trying times at this particular juncture we find ourselves in, interesting times. I'm not sure whether or not where you live, whether you are in lockdown or if you're moving towards lockdown, what the actual sort of situation is on the ground where you are located. But above all else, and really what supersedes the markets at this particular time is your own safety and, of course, your own health. So I just wanted to say, of course, just do the small things that are going to help not only you, but also your family. I mean, trading's important, but I don't think it's as important, right, as your health and your loved one's health. So again, just keep a simple balance between what's going on in the financial markets and obviously everything else that's happening around you. It's very important to remain level-headed during these times, and really, if I may say so, not to buy into some of the off-the-chart hysteria that really has gripped the financial markets, and, you know, rightly so, and also what people are doing outside of, right, or what's happening in the financial markets in just day-to-day life. I mean, some of the scenes, personally, that I've seen down here in Australia, at supermarkets, for instance, it just baffles me, absolutely baffles me. So again, just be mindful, be aware, look out for yourself, look out for your loved ones, and really just take care of yourself at this particular time. This time it will pass, okay? There will be, at some future point, a return to normalcy, right, in everyday life, and also that extends to the US financial markets. But really at this particular time, and again, moving into the close as at Tuesday, this market is completely erratic. It's completely bipolar. It's a kid throwing a tantrum at this particular point. I cannot personally remember a time in recent history, unless I go all the way back to 2008 to the depths of 2009, whereby we have seen these sort of 10% swings in both directions of price. Today, again, the market's up 5%. On Monday, they were down, 12, 13%. The day before that, the markets closed up 9%. Prior to that, they were down again, double digits, I think 9, 10% across the board. After the swing that took place to the downside, this is going back to Wednesday, the 11th of March. And prior to that, we saw again another bounce on Tuesday. That was Tuesday, the 10th of March. So again, sort of the back and forth choppiness, the absolute whipsaws that are potentially being produced in this market. Hopefully not for you. I do understand the majority of people in this or in pro are still in cash, which is fantastic. And again, I just wanted to reiterate, if you are looking at nibbling on market calls, number one, make them very small. Of course, obey money and risk sort of money management principles more than ever at this particular time. But if you find yourself doing absolutely nothing, and if you find yourself that you've essentially just sidestepped this carnage at this particular time, I don't see a reason, even right now, as to really be allocating any capital. Let me just walk you through why that is. We've been talking about perimeters, okay? The perimeter being on the downside, down at this lower trend level. Now, the jury's out, so to speak, on whether or not these trend lines are going to hold, right? Some have actually seen price action move below those trend lines. If I show you the S&P 500, and there has to be sort of a little bit of compromise here, because a lot of these trend lines are being extended all the way back to 2009. So where this extension really actually intersects with price, you have to give it a few degrees, right, of acceptance as to where truly that trend level sits. But again, the NASDAQ itself, pretty much sitting still on it. I mean, on Monday just gone, whereby the markets had an absolute hissy fit, where we saw the complete puking of the markets to the downside. As at today being Tuesday, and again on the back of continued, or as it appears anyway, President Trump at least setting up a further $1 trillion plus in fiscal stimulus to the economy. This is in response or in addition to the Fed, of course, slashing, historically speaking, interest rates, the cash rate down to 0 to 0.25%. Historical movements there. It was only really a month ago whereby the US cash rate was up at 1%. Now it's pretty much down at 0, effective 0. And they're also pumping as well. The market, as of really Monday this week, it's starting to become flush once again, as it has done during times of this bull market and even during the end of 2000, or at least the GFC, is that it's starting to become flush with liquidity. Now, the question becomes, is that liquidity going to offset, obviously, the carnage that we're seeing when it comes to probably public participation in terms of sell waves? I mean, obviously, the ordinary person out there wakes up, they sees the news, sees the world's about to end, right? Everyone's going to die. The markets are going to zero. What do you think naturally that person wants to do when it comes to his share portfolio? I mean, naturally, he's going to want to sell it. He or she, sorry. is naturally going to want to sell it. And we've got a lot of this hangover at the moment riding on the markets, whereby I assume not only this, but the Fed and also in terms of the fiscal stimulus by the Trump administration are doing everything in their power, essentially, right, to support equity prices and, broadly speaking, I'm not sure if it's going to be as effective, the actual broader economy. Okay, we haven't actually seen a legitimate bounce, a legitimate perimeter, a legitimate support area show up. But what we can see is that although we blew through both that support on Thursday and Friday, that being Monday's session, we've seen another lower wick on Monday. And what is naturally going to happen is that one of these wicks, and I assume it's going to be sooner rather than later based on just how oversold we are on the daily time frame and also on the weekly time frame, we're moving now out of overbought into more of a neutral setting, which is fantastic. But at some point in the near future, within the next 2 months or so, maybe as we see cases actually top out and begin to roll over, that would be absolutely fantastic for the crest of this virus, potentially seeing that spike at some point between now and even May of 2020. Essentially, I believe that's what the markets are looking for. Now, what happens between now and say 2 months' time, 8 weeks' time, it's anyone's guess. It's anyone's guess to the degree at which, right, locations around the world, cities, states, right, countries themselves are going to move into differing stages of lockdown by all accounts at this particular time. It's anyone's guess how the equity market is going to react to that news as it comes in. But what we can say again, that based on these perimeters, that the markets themselves, they're still essentially holding in there. They may not be, or at least all of them may not be above those trend lines, but you've got the NASDAQ that's sitting there. You've got the Dow Jones Industrial Average that has now moved below it. But again, it's really within a stone's throw away of that big, right, primary bullish trend line. I mean, you're talking to a degree of, say, 500 points. If you wanted to call this 21,750, we're down here at 21,230. So, I mean, again, roughly 500 points. The S&P 500 is a little bit lower, but this, again, is just extending to the volatility and that sort of manic state of market participants and the markets as a whole, and really society as a whole, the world as a whole, in the face or staring in the eyes of this coronavirus. Okay, so again, a lot of uncertainty ahead. I wouldn't really go out and start short selling this market. It's far too late to be doing that. Best case scenario, you've sidestepped the carnage, which is what I'm most proud of leading into, of course, the top in February of 2020. And really, if you haven't allocated capital at this particular time, I commend you for doing so, right? And I don't think, right, that now's a good time to be going out there and placing traditional orders that you would be if, in fact, we weren't seeing this amount of volatility, right? This volatility is surging off the charts, absolutely off the charts. So if you are, and if you cannot help but place trades at this time, just scale them back. I mean, scale them back to a fraction of what you would generally do. And of course, practice that money and risk management principles as well. I don't think it's time for you to be sort of jumping in the deep end of the pool. We're going to continue to follow along with this. But traditionally speaking, right, what we would do is we'd sit down and we'd look at the candlesticks. But if you go back and even think about this over the past week and a half, whenever you see a traditional sort of either bullish or bearish candlestick, right, and you expect X to happen soon after, essentially in this market, what you're getting is something completely different. And to such an extreme, it somewhat invalidates this, whereby a lot of this trading momentum is just going to be driven, of course, by the state of people waking up and whether or not they want to put risk on or take risk off. Okay, a lot of this is erratic, a lot of this is irrational, which is fine. But as a whole, these markets, they are going to find their true bottom. And when that time comes, and once we do see, of course, the de-escalation in open cases, what's naturally going to happen is that this is going to take off with the amount of the amount of liquidity in the market at the moment, the amount of monetary and fiscal stimulus that has just been enacted to help support this market and the broader economy. And then once we see, right, the top of these cases, and we can begin to definitively see that downward sloping back end, I mean, it's going to be an absolute fire sale to the upside. However, we're not there yet. And as such, these equity markets, they're just all over the place. So again, don't try and make sense of this. You won't be able to. I promise you won't be able to make sense of these markets. But what we can say is that the markets, there is still a little bit of a pulse. I think we can agree on that. There is still a little bit of life left in these markets. And really what we're looking for at this particular time is to see these oscillators definitively turn up. And more importantly, on the intermediate time frame is we want to see these oscillators, right, turn up eventually once they move towards oversold, I mean, you can see the RSI in the weekly chart. We're all the way down here at 18. The MACD is still accelerating to the downside. This is now the fourth negative week of net negative momentum. 1, 2, 3, 4. 1, 2, 3, 4. We're still seeing separation between the fast and the slow line, the stochastics. The fast line, at least, it's about 50, at least the midpoint now. You can see here, 50.72 between oversold and also overbought here on the price panel change. So we are starting to at least rebalance out of those extreme overbought settings that we were looking at. It seems like an absolute, a very long time ago, right? When we were up here firing on all cylinders, the markets were just continuing on their merry ways, looking for an opportunity for these markets to reset. The markets have found their match, be it all, COVID-19. They've reset. Momentum, of course, is still moving to the downside, but we're looking for an exhaustion on the weekly time frame. It still hasn't come yet, so that means we can see again the hangover of sellers still continue to rattle this market. But once we see this flip, it's really going to be a gauge of truth, the gauge of legitimacy as to whether or not, right, to the degree of angle that we're giving this, whether or not this is going to be a sustainable bounce. And of course, this isn't going to be concluded upon come Wednesday. This is something that's going to take a number of weeks, if not a number of months, right, further into 2020. Important thing to point out, LEIs are coming out this Thursday. We'll see what happens there. And of course, we're going to be following the US unemployment rate as well, which is going to be very telling, right, factually speaking, as to what the real damage is on the ground, which I think you should all be following along with moving forward. Also, I found quite an interesting relationship in the junk bond corporate market as well, and also equity prices, which I'll talk about this coming Saturday. But it's really going to be more important as at the end of March print on that indicator as well. But as it stands, don't take any of this market action personally. Refrain from trading, right? Just take the note that this is really sort of an anomaly in terms of trading circumstances and environment. And as such, I just don't see why you should be, right? If you don't have the stomach for it, and if there really isn't any justification at this particular time, right? Stressing about getting into the market, I just think a little bit, it's really just a little bit short-sighted. Okay, above all else, really at this time, I just wanted to wish you all, right, safe passage. Look out for yourself, look out for your neighbors, look out for your family. We will move beyond this. A time will come when we move beyond and we see the end of this, or at least we see the worst of this, right, in the rearview mirror. But until that time comes, which is probably again into the month of May, right? Hold on, strap in, and just be prepared for anything. Watch this market. Find it as a little bit of entertainment, really, at this particular point, because all you can really do is just laugh at some of these movements that are happening. Just don't take it personally. If you're not in the market, don't get into the market. But again, think about the perimeters and watch the weekly oscillators mixed with the daily oscillators, right? For potentially that of a multi-month, maybe even a multi-year, right, basing pattern. I understand people are expecting the worst. Generally, when everyone's expecting the worst, the market generally does the opposite. Okay, that's just the reality of financial markets. Okay, so again, I'm not calling a bottom whatsoever. Just saying follow along with it. Of course, I'm going to keep you updated. Yesterday, I just had to wait another session to see whether or not that 12% down day was reversed by another 12% up day. We did see an up day bounce. However, it wasn't to the extent of 10% plus. It was more so in the vicinity of 6. Still a net negative momentum change Monday through Tuesday. However, again, we're just going to be following along with this insanity that we're seeing each and every day. All right, so that's going to do for the Tuesday afternoon market recap. Stay safe, everyone. I'll be back later in the week for another market address. Farewell.